When the uranium price went from $18 a pound to $50 a pound, in other words, after the uranium price had almost tripled, after the easy money had been made, everybody cared. We're going to be talking about silver today, and some of your audience is going to say, oh shit, same old song from Rick. Silver, he's been talking about silver for 18 months. And 2 years from now or 3 years from now, when the price of silver is above $50 and the silver equities have all tripled, these same people who are snoring and yawning today are going to be begging you for a list of silver stocks after they've tripled. That's the lesson. It's just wonderful. Eric knows from his life's experience that precious metals bull markets are much greater in terms of duration and dimension than other people know. Most people, I shouldn't say most people, but many people have said to me, Rick, this bull market is by your reckoning already long of tooth. It's already 4 years old. They say the same thing to Eric. Both of us point out that the two prior bull markets in our career were 10 or 11-year bull markets, which is to say we aren't halfway through. And in terms of dimension, people say, well, the silver price has already gone from, $14 to $22 or $23, well, 30 on its way, and then on its way back down. Hasn't the easy money been made? Well, in the first bull market of my life, the silver price went from $1.50 to $50. In the second bull market of my life, silver went from a more advanced $5 to $50, which is to say a 10-bagger. So when people say to me that the bull market has run its course, either by way of duration or dimension, I say to them, perhaps you're not as old as me. Perhaps you haven't studied history, or perhaps you were just a lousy student. But the truth is that I think that the precious metals bull market is not at its midway point, that wind is in the sails of precious metals. And I have noticed in prior precious metals bull markets that the first half of the bull market was gold-centric, and the second half of the bull market was silver-centric. And when the momentum was established by gold, then silver picked up. And when the silver was established by the momentum occurred in physical silver, then the silver stocks, at least the high-quality ones, not the junkers, but the high-quality ones, really surprised people with the extent and the rapidity of the rise. Again, for an illustration, what I would point your younger listeners in particular to was what they saw happen in the uranium stocks over the last 18 months. Uranium did nothing for 3 years while the arithmetic was evident. It did nothing, even though the writing was on the wall that uranium had to go up and uranium stocks, pardon the pun, had to explode. We have the same circumstance in front of us now. The writing is absolutely on the wall with precious metals. History teaches us that when momentum is in precious metals, the market becomes silver dominant. And history teaches us too that the most explosive asset class in precious metals is silver equities. It's right in front of you. The lesson with regards to the uranium equities is right in front of you. But for most of your listeners, until the thesis has run its course, which is to say, until the opportunity is less attractive because of price, people won't care. The game is to care when Eric Sprott cares, when the arithmetic is right and nobody else gives a damn. 2019, 2020, the junior mining stocks in particular were up 100 or 200%. And beginning market capitalizations that I had thought were cheap at $20 million were $100 or $120 million. And while $20 million might be cheap, $120 million is substantially less cheap. So we got to a point in time where the so-called bargains were up by 300 or 400%. Now, to some people, the fact that they were up, the price validated the thesis. To me, the thesis needed no valuation. It's just that implementing the thesis required that I spend dollars where previously I'd had to spend quarters. And I prefer to spend quarters, not dollars. Now we're in a situation where the markets run full course. Although the gold and silver prices are roughly where they were 18 or 19 months ago, the price of the high quality silver producers has in many circumstances fallen by 30 or 40%. And the prices of many of the juniors have fallen by 75%. What didn't excite me at all at $1.25 has me fascinated at 30 cents, particularly if I can get a warrant in a private placement, which is to say, buy the stock for 30 cents and get the right to buy some more of it for 45 cents if I so choose. We live in a time that's going to be very challenging, but it's also a time that's going to be very, very rewarding. We are in a period of time of transition, which means that your mind is going to have to be flexible. And you're going to have to take advantage of the opportunities that exist precisely because other people haven't identified them. But I think it's going to be a very, very exciting time. Precious metals, yes. Battery metals, yes. For income-oriented investors, and I'm sure you have some listening to your channel simply because your channel is so big, owning oil and gas stocks, yes, the oil price has gone from 20 to 80, but so many people believe that the whole world is going to switch to Tesla by January. And so many other people are concerned about the fact that Biden and Greta and all those big thinkers don't like oil, that the oil companies are discounting $55 oil and $3 gas in a world where oil is selling for 80 and gas is selling for $5.50. If the oil and gas prices hold above $60 and $3.50 respectively, these stocks as a source of sustainable dividends are cheap and will continue to be cheap. And you don't need to go too far down the quality trail there. You can play that game just by buying Exxon. So I'm attracted to any number of things, Jake. What I'm afraid of is the way you led the interview off. There are a lot of people who see things very differently than me. And I think their outcome over the next 3 to 5 years is going to be very bad. And I think that their response to me doing well while they do poorly will not be to blame themselves for being lethargic sloths, but rather to blame me for being an applied, aggressive thinker and actor. That's what bothers me. Investors of my age have been trained over the last 40 years that everything's under control, that no matter what sort of difficulty we get ourselves into, be it the tech wreck of 2000, the liquidity squeeze of 2008, the more recent COVID squeeze, it doesn't matter that the Fed has your back. The problem with that thesis is that the Fed has already spent its easy ammo. Do they take the interest rate below zero? Do you have to go to the bank and give them a toaster to open an account when they used to give you toasters for opening an account? My point is that what worked in the past doesn't necessarily work in the future, but the expectation of the future has been set by investors' experience in the immediate past. And in the immediate past, things just got better and better and better. And if any time things didn't get better, then the Fed came to your rescue.